Good morning, this is Dan Passarelli with Market Taker Mentoring here on the floor of the CME Group. Today I have an interesting trade idea that we discussed in our Market Taker Live Advantage group coaching class. This is a somewhat speculative trade. The trade is in SandRidge Energy, stock symbol SD. Now SandRidge has earnings tomorrow, and it also is in the middle of a little bit of a fight. There's a little bit of a fight between current management and one of the largest stockholders. If you look at a stock chart of SD, you'll see that it's fallen drastically from a couple of years ago, very drastically, and one of the largest stockholders isn't happy about that. They want to oust current management and take it over themselves. So, right now the implied volatility of the short-term March options is significantly above the implied volatility of the April options. Why is that? Well, it's because of earnings and it's because of this proxy battle going on right now. This gives us an opportunity to potentially take advantage of this situation. Here's the trade that I made. I sold the March 5 puts and at the same time sold the March 5 calls. And then I also bought the April 5 puts and the April 6 calls. This is called a double calendar. Some people might refer to it as a strangle swap. The gist of the trade is this. As long as the stock doesn't move too much on earnings or on this proxy fight, the stock will the option position will profit significantly based on implied volatility collapsing and of course as time passing, because this is a positive theta trade. So we have one element of risk coming tomorrow, that is after the close, earnings are expected and the stock can move a little bit. I anticipate I'm losing a little bit on gamma here, but hopefully what I make on implied volatility and time passing will make up for what I lose on the negative gamma move. That is the move of the actual stock price. Then it's a waiting game to see how this proxy fight plays out. Incidentally, the final day for votes to be cast on whether or not to oust current management is March 15th, which happens to coincide with March expiration. If the stockholder gets enough votes before March 15th, the deal ends then. So this is a precarious trade that's going to have to be watched, but it's one that I'm in and one that I'm looking to see work out. If not, I might have to do a little bit of damage control, do some adjustment techniques like we teach at markettaker.com, and we're going to see how it plays out. This is Dan Passarelli here on the floor of the CME Group.